In the autumn of 2006, while the financial press was celebrating record home prices and CNBC was running segments titled, "Is this the greatest bull market ever?" a quiet, almost invisible exodus was already underway. It wasn't happening in the headlines. It was happening in quarterly filings, in private wealth management memos, in the asset allocation shifts of sovereign wealth funds that most retail investors have never heard of. By the time Lehman Brothers collapsed in September 2008, by the time your neighbor lost his job and your entire 401k lost 40% of its value, the ultra-wealthy weren't panicking. They were shopping. Most people think a crash is the moment everything falls apart, but a real crash is a prash. Pre-scheduled wealth transfer, and the transfer happens before the headlines, not after. This is not a theory. This is a forensic pattern, documented across 1,929, 2001, and 2008, repeating with near mechanical precision. And right now, in the current macro environment, the same silent signals that preceded every major liquidity crisis of the last century are flashing again. Today, we perform the diagnosis before the symptoms become a headline. To understand what's happening now, we need to understand the mechanism, not the narrative. The narrative says, interest rates rose too fast. A few banks got careless. The system corrected. The mechanism says something entirely different. What we are witnessing is a textbook Minsky moment, a term coined by economist Hyman Minsky, whose life's work was largely ignored until 2008 proved him catastrophically correct. Here is how it works. In periods of prolonged stability, investors take on progressively more risk. Not because they are reckless, but because stability itself creates the illusion that risk has been engineered out of the system. Debt levels rise, asset prices inflate, and crucially, the correlation between asset classes quietly converges toward one. That last point is critical, and it's what retail investors almost never catch in time. Asset correlation is the degree to which different investments move together. In a healthy market, stocks, bonds, real estate, and commodities behave differently. That diversification is your protection. But in the late stage of a Minsky cycle, something dangerous happens. Assets that are supposed to be uncorrelated begin moving in lockstep. In 2008, we saw it with catastrophic clarity. Mortgage-backed securities, equities, municipal bonds, and commercial real estate all collapsed simultaneously. The diversification that investors were sold as protection evaporated overnight. This is not random. This is the doom loop. Inflated collateral values support over-leveraged debt. When one asset class cracks, margin calls force selling across all asset classes. Prices fall further. Collateral is destroyed. More margin calls. The architecture of the system doesn't just bend, it inverts. Now look at the present. Corporate debt as a percentage of GDP remains near historic highs. Commercial real estate faces a refinancing wall of approximately $1.5 trillion through 2025 to 2026. Regional bank exposure to that same commercial real estate sits at levels not seen since 2007. And asset correlations in the current environment have quietly begun their convergence. The signals are not loud. They are precise. Here is where the forensic analysis becomes actionable and where the gap between retail investors and institutional capital becomes most visible. In every major liquidity crisis, there are two categories of assets. We'll call them radioactive assets and underlying assets. Radioactive assets are derivative in nature, meaning their value is entirely dependent on the stability of the system that created them. They look safe in normal times. They are catastrophic in crisis times. Think of leveraged real estate in 2006, not the land itself, but the debt structure layered on top of it. Think of Greek equities between 2007 and 2012, which suffered a drawdown of over 92%, not because Greece stopped existing, but because the financial architecture around Greek assets collapsed. Think of mortgage-backed securities instruments so complex that the banks selling them couldn't fully price their own risk. The common thread, derivatives of value, not value itself. Underlying assets behave differently. They are the source of value, not a claim on it. Productive farmland, essential skills, physical monetary instruments. These assets existed before the financial system was built around them, and they will exist after any reconfiguration of that system. Consider this data point. In 1929, as equity markets began their catastrophic descent, the U.S. Postal Savings System, a government-backed savings vehicle most Americans had completely ignored, grew by over 800% in deposit volume. People weren't becoming suddenly patriotic. They were moving toward instruments backed by sovereign guarantee rather than institutional solvency. Bill Gates didn't make headlines buying derivatives in 2008. He made headlines quietly, through a trust structure acquiring over 270,000 acres of American farmland. That's not a coincidence of taste. That's a forensic signal. Now here is the critical question. Why do the ultra-wealthy move 18 to 24 months before a crash? The answer is both structural and strategic. Structurally, institutional capital is too large to move quickly. A sovereign wealth fund cannot liquidate a $40 billion equity position without becoming the crash itself. So they move slowly, deliberately, and early rotating out of radioactive assets, while retail volume still supports the price. Strategically, the early mover captures something retail investors almost never do: liquidity at the moment of maximum opportunity. This is why T-bills are not simply safe assets in institutional portfolios. They are ammunition, short duration, sovereign-backed instruments that convert seamlessly to purchasing power at exactly the moment when distressed assets are available at generational discounts. The 1% does not flee a crash. They finance it. So what does the individual investor operating without a sovereign wealth fund or a private family office actually do with this diagnosis? We use what we call the 1929 layered safety architecture, updated for the current institutional landscape. Layer 1, FDIC and NCUA coverage. Your first $250,000 in any bank or credit union is federally insured. This is your baseline, not your strategy. Know your limits. Know your institutions. This layer is not about growth. It's about non-loss. Layer 2, Treasury Direct. TreasuryDirect.gov allows individual investors to purchase U.S. Treasury bills directly from the federal government, bypassing brokers, bypassing bank intermediaries, bypassing institutional counterparty risk entirely. This is institutional logic made accessible. Short duration T-bills, rolled quarterly, give you sovereign-backed liquidity that positions you like institutional capital to act when distressed assets become available. This is your ammunition layer. Layer 3, physical monetary instruments. A measured, disciplined allocation to physical gold and silver, not speculative, not leveraged, provides what economists call monetary translation capacity, the ability to preserve purchasing power across currency regime shifts. Weimar 1923 is the extreme case study. But currency debasement doesn't require hyperinflation to erode real wealth. Layer 4, institution-proof skills. This is the layer most financial channels never discuss, because it doesn't generate assets under management. But forensically, it is perhaps the most durable. In Argentina's 2001 collapse, the professionals who maintained income weren't the ones with the most complex portfolios. They were the electricians, the mechanics, the physicians, the people whose value proposition existed outside the financial system's ability to price or destroy it. We call these institution-proof skills. The capacity to repair, to produce food, to translate between monetary systems, to provide essential services regardless of what the Dow is doing. These are not fringe concepts. They are the documented survival strategies of populations who have lived through the theoretical scenarios that most Western investors treat as impossible. Let's return to where we started, September 2008. The moment most people remember as the beginning of the crisis was, forensically, its conclusion. The public phase of a wealth transfer that had been executing in silence for 18 months. The signals were present in 2006. The mechanism was visible in 2007 inches. The Minsky buildup in the asset correlation convergence, in the quiet rotation of institutional portfolios toward liquidity. History does not repeat with perfect precision. But the mechanism repeats because human leverage cycles, credit expansion, and institutional positioning follow structural logic that transcends any individual crisis. The prepared understand this. For them, a crash is not a catastrophe. It is a scheduled shopping event the moment when decades of silent preparation convert into generational asset acquisition. The unprepared read the same headlines, feel the same panic, and sell the same assets into the same institutional buyers as they did in 1929, in 2001, in 2008. The only variable is which side of that transaction you're on. History isn't the past. It's a running diagnosis of the present. Subscribe so you don't become the next case study.